Good morning, everybody. We are here from the Student Skill Enrichment Board. And as you are aware, the Student Skill Enrichment Board is from Board of Study Operation, and we are here to enrich our students all over India. The Enrichment Board is organizing various sessions, seminars, conferences regularly with the support of our branches and regional councils. We are also organizing practical training modules every Sunday from 10:30 a.m. till 1 p.m. Today is the 18th live webinar session. This session is always recorded and available on the YouTube channel and also on the DLH platform in the Student Skill Enrichment Board. Here the PPT is also uploaded so that the students who have not been able to be live at this time, they can look after the session afterwards. And we are receiving a lot of queries and questions that we should be coming up with new topics. And today we are having with us our respected Central Council member, CA Durgesh Kabra ji. Durgesh Kabra ji is a senior member having an extensive experience of more than 30 years in the company law, corporate structuring, management advisory, audit and insurance services. He is an avid speaker and an expert in law and bankruptcy code. He has also addressed more than 180 seminars, forums, conferences on company law, LLB, insolvency, and bankruptcy. The list is endless. He is a strategic leader to the code. And he has also taken various initiatives while he was a chairman in WIRC. He's an active and responsible member of trade and industry. We are here, and today we are also having with us our speakers, CA Aseem Prakash and Ankit Bhora ji. I welcome you, sir, Durgesh Kabra ji. Please.
Thank you, Ginny. It's my indeed pleasure to be part of this 18th webinar on tax audit, organized by Student Skill Enrichment Board. And it's a fantastic initiative of the SSEB under the leadership of CA Sushil Goyal, who is the chairman of the board, and CA Sridhar Muppala, who is the vice chairman of the board. These two leaders at the helm of affairs of this board are doing a lot of things for the students. They are always trying to have something unique for the students, that how the students can be benefited in a much more way. The way the facilities are being there for the students today, probably you will find that there will be more facilities as far as learning is concerned from the Institute of Chartered Accountant of India, the Skill Enrichment Board of ICAI. Friends, the ICAI has thought of to divide the Board of Studies into two. One is Board of Studies Operation and another one is Board of Studies Academics. And this SSEB is there, which is known as Board of Studies Operational. And under this, all the learning activities, all the skill set development activities of the students, all other extra curricular activities are being done by this board. And let me tell you, every time there is a unique idea. And this series is part of that unique idea, where the practical training is being given to the students who are pursuing the articleship in various forms. And when the practical tips are given, they perform better in the organization where they are working, in the firms where they are working. And I'm sure, friends, that when you learn through these experts who are there to guide you on the various topics of your interest, of the interest of the profession, I think the ICAI produce the best of the quality of the chartered accountants. You all know, friends, that today there is a huge demand of the chartered accountants. The numbers which are there who are passing the CA exam are less, and the vacancies for the freshers are more. The only thing which one need to understand and one need to learn is the performance, the communication, the soft skill. Beside this, your academic skills. And why I'm telling you all these things? These all can come when you attend these kind of webinars, you attend conferences, you attend the lectures organized either physically or virtually, which will give you the strength to interact with the, when you are attending the physical one, you will be in a position to interact with the speaker. It will give you the strength how to ask question, what to ask, what not to ask, and how to understand, how to have the networking. It will boost you with the confidence. And when the confidence comes in all of you, friends, one day you will be the speaker. And that is what is needed from all of you. That every chartered accountants start leading from the front. So whenever I go into any conference, I request all students that please come in the front rows. The chartered accountancy profession is there to lead from the front and not to lead from the back. Time has gone when it was the back office work. It was only accounting work or auditing work. But today, we are the complete business solution provider. We have been known as partner in nation building. So you have joined a course, my dear friends, where you are going to be a part of the partner in nation building. You are going to be a part of the complete business solution provider, because the extensive training of 3 years, students who take it seriously, I'm sure, friends, he know how to interact, how to deal with a different kind of people. Because when you are going for the audit, when you are going for the assessment, you are dealing with different person, different skill set person. And when you deal with these person, you come to know how to deal with X, how to deal with Y, how to deal with Z. Because everybody is having different skill set, different mindset, different attitude. You have to change accordingly. And a person who believes in changing himself, I think he is the winner. The change is constant. All other things are static. So whatever you want to grab from anyone, you can learn from failures. You can learn from success. So there are many things which can be taken from the failure as well as from the success. And I'm sure, friends, when you think positive and take all these things with you, I think this is going to help you out all. I have been called for this webinar. The subject is not mine, tax audit. Though I have done tax audit, I signed tax audit. When I was in the initial phase of my practice, I was to read all these tax provision. But let me tell you, my subject is company law and audit. But still I said, yes, I'll go and I'll address you. I may not discuss the various clauses which are there in the tax audit reports, which is there under section 44AB, but probably I'll discuss some things which will give you some boost that how the confidence can come. And friends, I am also a person from a very small place called Chittorgarh and came, did all these things. I was a person who was to speak only Hindi and Marwadi. But today, before all of you, I'm speaking in English too. So this is all comes from within when you start leading from the front. And friends, though I was in my class, being the tall person, I was a backbencher. The teacher was to force me go and sit on the back. But when I joined CA, I thought I must sit on the front. And that's how the journey began. And tomorrow, it can be you, my dear friends. So my humble request, have a confidence. Stop comparing with others. Think positive. Decide about goal. Work for that goal. Take actions. All this will help you out to achieve success in your life. First, to achieve success in exam. The continuity is needed for everything. Failure is the first step to success, I would say. So let us not worry about the failure. Forget it. Failure comes and goes, but success will always be there. So let us not worry and continue your efforts. Continuity, perseverance will only help you to get success in your life. And I'm sure, friends, the initiatives which are being taken by the Student Skill Enrichment Board, by Sushil Goyalji, by Sridhar Mupalaji, and the Secretariat and their staff and the officers of the SSAB, they are doing wonderful for the students. I will request all of you that there are various national conferences, various student conferences. It is a must program for all of you to attend. You must attend whenever you get opportunity in your area that there is a student conference. And I'm sure, friends, if you attend, you'll find something new at each and every conference. And it is rightly said, यद भावो तत भवति, जैसा आप सोचोगे वैसा आप बनोगे. एंड इट इज अप टू यू. आपने क्या सोचा है? पहले अटेम्प्ट में पास होना, दूसरे अटेम्प्ट में पास होना, तीसरे अटेम्प्ट में पास होना, ये आपके ऊपर डिपेंड करता है. आप टैक्स में एक्सपर्ट बनना, इन्वेस्टमेंट बैंकिंग में एक्सपर्ट बनना, ऑल दीज डिपेंड्स ऑन यू दैट which subject you want to, because the time has come for this specialization. If you don't have this specialization, people will not look on you. The client will not look on you. Stakeholder will not look on you. So you need to be specialized one. So friends, I'm sure that the initiative which are being taken will help you a lot in these kind of things. And today, Ankit Bohra is going to guide you with the various question answers which you have doubt in your mind. And Asim Prakash will lead from the front to guide you on various classes of the tax audit which have been decided. This is the third seminar on the tax audit, and every chartered accountant need to learn this. Every student need to learn this, because in each of the firm, whether they have the statutory audit of the company or not, but the tax audit is 100% there. And when the tax audit is there, the duties of performer of the tax audit is that we need to perform with ethics. We need to do our duties very judiciously, very responsibly. So the best work can be done, and best quality in the audit can be given, best quality in the assurance can be given by the person who is performing the assurance and audit function in the firm. It's all you, my dear friends, who starts the audit, and your senior ends the audit. But when you start the audit, you learn a lot. A person who has already learned a lot, a person who is senior in your firm, a chartered accountant, a partner, probably may not give that much time and attention. But when you have to learn, you will give a lot of time. It should be a duty that you try to understand each and every clause, why this clause is there, what kind of reporting should be there into it. Guidance note is there. Go through guidance note. It will build your skill set. It will give you the confidence when you do all these kind of study. And audit, as is told by our President Sir, Debashish Mitraji, that it is a very serious subject. So it should not be taken easily. We are auditor. Our mindset should be of questioning. If we don't question, then we are not the auditor. हमें हर चीज शंका की दृष्टि से देखनी है. We need to see each and everything with the doubt. And when we have that questioning attitude, I think this is going to help us like anything, and we will be doing our work responsibly, judiciously, and when we do judiciously and responsibly, I think, friends, there is no one who will be in a position to raise fingers on us, which is being done today, because somewhere we are failing into our these duties. I hope, learning from today's session, learning from the future session, you will be building your skill set, and you will perform best in your life, and you will be successful chartered accountant. Thank you all. Over to Guinea, and wish Asim and Ankit a very good session today, which they can give it to the students. Thank you all.
Thank you, sir. Thank you for motivating the students a lot. And you have perfectly said, जो हमारे बच्चे आज के हमारे प्रोफेशन के तो फ्यूचर हैं, but they are future for our country. So in order to shape our country, you have to develop it a lot. You have to motivate yourself that you can go through it and you can achieve what you want. Over to Asim ji. Now, Asim ji is a commerce graduate from St. Xavier College, Kolkata, and a fellow chartered accountant. He's a regular speaker on the topics related to direct tax and bank audit. He has written many articles for many magazines and journals, and he is also a faculty in ICI for the students training program and other institutions. He has bagged an exotic experience from the Infosys as a direct tax consultant for none other than Income Tax Department of India. He has worked as a tax consultant for more than 2 years. And he has also been awarded with the prestigious Gladiator Award for the outstanding contribution from the Infosys. Over to Asim Prakash ji. Asim ji, we can't hear you.
No, probably because of your earphone. Some attachment is not proper in case of earphone.
Meanwhile, Asim ji is checking the speakers. We can give you a short introduction of our second session speaker, CA Ankit Bhora ji. Ankit Bhora ji is also a qualified chartered accountant and currently a part of a Deloitte company. His core location is in Kolkata, and he has completed his articleship from ALP and Associate, a firm in the Kolkata. During his articleship period, he has gained a sharp knowledge of direct taxation and statutory audit. And he has also assisted in the search and seizure cases and cases involving litigation up to IT-80 level. We welcome Ankit ji. Asim ji, can we start the session now?
Yeah, am I audible now?
Yes.
Very good morning to one and all.
Yes,
Morning.
you are audible.
Yeah. So a nice celebration by CA Durgesh ji, and he has motivated all the students on this Sunday morning, and a great initiative by the board. Special thanks to CA Sushil Goyal ji and the entire team who have given their best to organize this. So the topic of the day, coming straight to the topic, is tax audit. And as we all are familiar that in the month of September, we are discussing tax audit and how crucial it is to discuss the intricacies and nuances of tax audit. And that is what we'll do. And we'll be discussing tax audit from clause 21 onwards. So let's come to the topic. You see my screen?
Yes.
Friends, there are the way the heading of the clauses in tax audit has been drafted. It seems that people tend to misunderstand clauses at many places. What tax audit we have come across, that there are expenses, there are heads which look like see the screen?
No.
As my right has been denied, is it?
Yeah.
I'm not getting the option itself. Yeah, I can get the option now. Yes, the screen is visible.
Yes. Yes.
Yes. So the heading itself talks about, please furnish the details of amounts debited to profit and loss account being in the nature of capital, personal, advertisement expenditure. So my friends, the topic itself, the clause itself, the heading of the clause itself talks about that if the amount has been debited to profit and loss account, then we have to give our comments. There have been instances where I have come across tax audits where, that capital expenditure, even they are not debited in the PL, then also it has been mentioned. So that is not the intention of the legislation. The intention of the legislation is to find out that is there any capital expenditure which has been debited in PL. So the intent of the legislation is that if any capital expenditure which is not supposed to be debited in PL, that has to be disallowed. And that is why they want us to mention it here. So that is the first thing. The first checkpoint is that find out whether these expenses has been debited to profit and loss account or not. If at all they have been debited, then further we'll have to give our comments that if there is any capital expenditure. And how are you going to find out capital expenditure? Accounting standards are there, which will tell you that whether a particular expenditure is capital expenditure or not. If a particular expenditure related to asset is there, and it has to be capitalized, for which you are going to get future benefits, and somehow it has been debited in profit and loss account, then that particular expenditure has to be capitalized. If at all they have debited to PL, we have to give in a comment and we have to write it here. Another thing, what I want to point out is that you must have come across many intimation orders on section 143(1) issued by CPC, where straight away these figures, whatever figures we are putting in clause 21A, are being added back in CPC orders. Somehow CPC, the orders passed by CPC in a rampant manner. I am not in agreement with those orders because CPC cannot add the expenses right away without getting into the intricacies and into the understanding whether those are business expenses or not. We'll come across the detailed discussion about why I'm saying so and why I'm questioning the stand of CPC. And one question for my organizers that do I need to speak English or whether all students quite familiar and they are comfortable with the language for the organizers? Any ma'am? Or for better understanding, there has to be a mix of Hindi and English. Ma'am, are you there? Hello. Hello.
Yes.
Ma'am, are you there?
No, Azim sir, you are not audible. No, sir, you are not audible. No, sir.
Hello.
Yeah, you are audible. Yeah.
Now audible.
Okay, fine. Okay, fine. So what I was telling is that capex, if at all debited in PL, it has to be it has to be made sure that the same is mentioned here, and to bring it on at parity in the ITR, there's a schedule called OI. In schedule OI, you have to mention the same, that this is a capex which has been debited to PL, so that the same can be added back in schedule BP. Otherwise, if you are mentioning some expenditure over here, and if you're not mentioning in ITR, then intimation is going to come, which is going to be issued by CPC, in which this entire expenditure will be added back. Coming to the next expenditure, personal expenditure.
Now here a rationale has to be taken and a decision has to be taken by the auditor that whether a particular expenditure is in the nature of personal expenditure or not. For this, the entire discretion has to be taken by the auditor, provided you take a management representative letter. Personal expenditure. Personal expenditure. For personal expenditure, we have to take a management representation letter from the management which talks about that for a particular expenditure, whether it is personal in nature or not. For example, we talk about motor car expenses. A particular motor car has been used by the business for business purpose, but there can be a scenario that the same motor car is being used by the director for his personal purposes. So the amount of, the expenditure on fuel and the expenditure on the driver, the same has to be segregated in a manner that to what portion the amount has to be apportioned to personal expenditure and to what portion the amount has to be apportioned to business expenditure. For these things, representation is also preferred, and at the same time, our judicious nature has to be played and come into picture that whether it is correct or not. Because in cars, generally they maintain a logbook, which can also be taken into consideration that whether what kind of expenses have been done for personal expenditure. So apart from MRL, there has to be working papers to back up your views, whatever views you have been taking in the tax audit. MRL, management representation letter, will not only serve the purpose that something which has been given as a representation by the management that should suffice your purpose. You have to dig deeper and you have to find the evidences, the corroborative evidences which should support the same representation. And if at all you have a different opinion, please mention the same. Coming to the next point, advertisement expenditure in any souvenir, brochure, tract, pamphlet, or like published by a political party. So any expenditure of this nature, if you find it, which has been booked in the PL, the same has to be mentioned here. It will be disallowed and the same has to be taken care in Schedule OI because it is an expenditure which is not allowed as per Income Tax Act. Coming to the next expenditure. Expenditure incurred at clubs, being entrance fees and subscription. Now, friends, this is a particular expenditure where the auditors sometimes tend to take a stand that though the expenditure has been incurred at clubs being entrance fees, but it is for business use, and that's why they do not mention it here. My humble submission is that you are not the person in the chair of a judge where you will judge the expenditure, whether the expenditure is of personal nature or for business nature. What we are supposed to do here in this particular clause is that if at all there is an expenditure in the nature of entrance fees for clubs, the same has to be mentioned here. There might be a scenario where the entrance fees and subscriptions in a particular club is exclusively for the business, and we can see a direct nexus from the business. Then also we have to mention it here. Unfortunately, CPC will add it back. If at all it is adding it back in a rampant manner, then the same has to be added. Then the same has to be contested in appeal. But in the capacity of tax auditors, we are not in a chair to decide for this particular clause that whether the business expenditure, whether this particular expenditure is in the nature of business or not. And we have to mention, if at all it has been incurred, we have to mention the same amount here, and whatever fate it takes, whether it is allowed or disallowed, that will be decided by the authorities of the income tax. But as income tax auditors, we have to give in the amount which has been debited to PL if it is of nature of entrance fees and subscriptions. Expenditure incurred at clubs being cost for club services and facilities used. Again, I will reiterate whatever I have stated for entrance fees, that there can be a scenario where you can see that there is a direct nexus that in the club, there was a particular cost incurred and that particular cost has got business, has increased the turnover of the SSE. But since it is a club incurred in the cost, we have to mention it here. And if at all CPC takes a stand that it has to be added back, it has to be added back and the same has to be contested. But as auditors, we cannot afford to decide whether a particular expenditure is in the nature of business or personal. And accordingly, if it is the nature of business only, then we will exclude it. It is not so. It is something which we cannot afford to do. If it is in the nature of club expenditure, it has to be mentioned here, as simple as that. I guess there will be rule changes at CPC. where, or there will be further sub-clauses, which I propose that there has to be further sub-clauses added here, that expenditure in clubs related to business and not related to business, if at all it is there. And since I have a different understanding also for this, that since they have already given a separate head for personal expenses, then ideally the CPC should not disallow straight away in a rampant manner these expenses, what they have been doing right now. They should have only disallowed the personal expenses, if at all there is a mismatch in the ITR and tax audit. And they should not disallow these expenses, because the auditor has already taken a conscious stand before mentioning these expenses. And had it been a case of personal expenses, he would have mentioned the same portion of club expenses in personal expenditure. Ideally, if that is the scenario. So that is something which I propose to CPC. And they are not the party to our audience here, but we'll be giving we have already given a written proposal in the past also, and we'll be pursuing them for this. Expenditure by way of penalty or fine for violation of any law. Friends, make sure the word to be expressed is any law. It has to be covered under any law, and it has to be in the nature of penalty or fine. Generally, a common expenditure which we come across is interest and late filing of TDS. Let me tell you that late filing of TDS, it is not in the nature of penalty and fine. It is in the nature of fees. If you go through the section also, it talks about fees. The 200 rupees per day fine, whatever is there, 200 rupees fees is there for late filing. That is not in the nature of penalty and fine. So please do not disallow it. It talks about expenditure by way of penalty or fine for violation of any law. So if at all you find any particular section of penalty and fine, go through the section of that particular act, because a particular amount which has been debited in PL under this head of penalty or fine, there must be a section attached to it and an act. If it is a penalty or fine under GST, please refer to the particular section of that particular act and go through the words, that whether the word penalty or fine is mentioned in that particular section or not, because there must be an order against which this particular expenditure has been booked. Ask for that order as a working paper, examine the order and the section under which that order has been passed. If the section under which order has been passed, that section talks about that it is in the nature of penalty or fine, then only it will be disallowed, otherwise it will not be disallowed. Similar, we talk about expenditure by way of any other penalty or fine not covered above. Since it is about legal concept, that the above thing, what we discussed was law, here we talked about which is not covered by law, expenditure by way of any other penalty or fine not covered above. Ideally, this will not be disallowed, because we talk about only legal penalties which will be disallowed. This can be in the nature of business expenditure, that there is a penalty for suppose there was an agreement between two parties, and for not complying with that particular agreement, there is a penalty on you. Ideally, this is a business expenditure, and there is a concept that since this is not a legal penalty, this will not be disallowed, but we have to mention it here. Expenditure incurred for any purpose which is an offense or which is prohibited by law. So anything which is prohibited by law, suppose if your SSC is unfortunately into smuggling or something, so whatever expenditure he has been incurring for smuggling that product, for all those expenses has to be disallowed. That's why they're asking for expenditure incurred for any purpose which is an offense or which is prohibited by law. Suppose the gold is there and import of gold has to be done as per law. And if your SSC is found to be importing gold in an illegal manner, then those expenses which are incurred to import gold in an illegal manner has to be mentioned here, and the same will be disallowed. Amounts inadmissible under Section 40A, a very important section under Income Tax Act, which stresses on the TDS concept. TDS is a very important concept, and it adds revenue to the income tax department. We have to make sure that whatever expenses are subject to TDS, TDS has to be deducted on those expenses. What happens if TDS is not deducted? In case of non-residents, the entire expenditure on which TDS has not been deducted will be disallowed. So you can see the impact, that entire expenditure will be disallowed in case of non-residents. What happens in case of residents? The law has been liberal enough that in case of residents, if TDS has not been deducted, 30% of the expenses will not be allowed as business expenditure. My friends, it is my earnest request, make sure, push your clients to deduct TDS, wherever TDS is applicable, because it will have huge consequences. Now, there's a scenario that as tax auditor, in the welfare of your client, if tax has not been deducted somehow, what is the way out? How can you save this 30% disallowance if TDS has not been deducted? There is a way to avoid this disallowance of 30% expenditure. The way is to file a form called 26A. What is there in form 26A? First of all, let us understand that why TDS is there. TDS makes sure that a particular expenditure on which TDS is deducted, if it is reported, Income Tax Department can ask for tax on the concerned person, from the concerned person for that particular amount. Now, if a CA, an independent chartered accountant, gives a certificate that the deductee, person A, who has paid for the expenditure, and person B, who has raised the bill for the expenditure. Person B is the deductee. So, person A, who was the deductor, has failed to deduct TDS. And if he files from Form 26A, in which there is a certificate to be signed by a CA, and if the CA gives a certificate that person B, being the deductee, whatever amount he had received as income for that expenditure, for that service, whatever was provided by him, if he furnishes the same amount in his ITR and has taken the same amount into consideration for calculation of tax and income, in that case, there is no tax evasion. Ideally, the tax has been paid. It is just that TDS has not been deducted, but tax has been paid. So this is a tax neutral scenario. In this particular case, your 30% disallowance will not be applied, but the interest portion. Suppose in the month of April 2022, a particular expenditure was incurred in your file in the case of your client, and your client failed to deduct TDS. Since TDS has not been deducted, but person B, who had provided that service, he had filed his return in the month of August 2023 or September 2023, in which he had taken the same amount in his ITR for calculation of his income and tax, then there is no tax evasion. He has paid taxes duly on that amount, but there is a delay of April to September. And because of this delay, tax department, what amount it was supposed to get in the month of April, they are getting in the month of August or September, as the case may be. So you have to pay interest from this month, April to August. That is the only thing what you have to pay, but 30% disallowance will not happen, and you can get away without any disallowance. How it has to be done? You have to file a form 26A, which is available on Traces. Make sure you file the form if TDS is not deducted. Now, where TDS has been deducted, amounts inadmissible under Section 40A. If at all there is a scenario where TDS has not been deducted, the same has to be reported in Clause B, 21B, as payment to non-resident. Details of payment on which tax is not deducted, date of payment, amount of payment, nature of payment, name and address of the payee. Details of payment on which tax has been deducted but has not been paid during the previous year or in the subsequent year before the expiry of time prescribed into Section 201. Date of payment, amount of payment, nature of payment, and name and address of the payee, amount of tax deducted. So they are asking of all the details if tax has not been deducted, if at all tax has been deducted but not paid. Any payment referred to in subclause 1A, this talks about the resident portion. Details of payment on his tax is not deducted, and details of payment on tax is deducted but has not been paid. So it talks about that if at all the disallowance is same, that TDS has been deducted and not paid, then also the department is not getting any benefit. It will be disallowed. If at all TDS has not been deducted, then also it is the same case that there will be disallowance. And we have to make sure that all the expenses on which TDS was to be deducted and TDS has not been deducted, we have to make sure that these particular clauses have to be filled And in cases where TDS has been deducted but has not been paid, then also these particular clauses, relevant clauses, have to be filled. And if at all Form 26 say filing has been done, compliance has been done, then this particular clause need not be filled. Because as an auditor, you can take a stand that though the TDS has not been deducted, but the compliance under section 200, whatever is there, because once you comply with Form 26, say you're not a SSC in default, and that's why not supposed to fill this particular clause. Moving on to the next clause. In the meanwhile, I'll also share my presentation with you for better clarity. Can you see the screen? The PowerPoint? The folder is visible. Can you see it now?
Yes, sir.
Yes. The presentation is there? Great. Okay. So further, moving on to the next points. Surcharge and cess. There has been a recent amendment which talks about that any tax other than Income Tax Act will be allowed. So surcharge and cess is a part of tax, and you cannot take the benefit of surcharge and cess under Income Tax Act. This welcome amendment was done in the recent budget, budget of 21, I guess 22, where it will mention that surcharge and cess cannot be taken as expenditure. Wealth tax is something which cannot be allowed as expenditure. Any royalty fees payable to state government by state government undertaking, if it at all it is there, the same has to be mentioned here. Any payment to PF or other funds if TDS arrangements are not done. These are the clauses where what we are discussing is under clause 2A, subclause 3B, date of payment, amount and name and the address of the payee. The clauses 3, 4, 5, and 6 we are covering. The screen is visible, I'm sure, which talks about surcharge and cess. Then wealth tax is there. Then we are discussing any royalty fees payable to the state government by state government undertaking. And this is the clause 6, which talks about any royalty fees, any tax on perquisite by the employer. Moving on to the next clause, amounts debited to profit and loss account being interest, salary, bonus, commission, or remuneration inadmissible under section 40B and computation thereof. Another important section which talks about the partnership firm. In partnership firm, we have, first of all, we have to find out that whether the deed is there or not. If the deed is there, we have to make sure that as per deed, what is the relevant clause for remuneration and interest? And for interest, remuneration, and commission, what are the percentage allowed as per the deed? Once the deed is there, then Income Tax Act comes into picture. For remuneration, there is a slab which talks about that till the extent of 3 lakhs, 1,50,000 or 90%, whichever is higher. If at all it is exceeding 3 lakhs, then 60% of the profit, book profit. There is a way to calculate book profit. 60% can be allowed as remuneration. For interest, 12% is the maximum amount which can be paid as interest on capital to the partners of the firm. So this particular clause is only applicable in case of partnership firm and LLP, which talks about the salary, bonus, and commission. Again, friends, you'll go through the heading which talks about amounts debited to PL account being interest, salary, remuneration inadmissible. If at all there is a scenario where everything is admissible, you need not fill this form. But the way there you'll see the breakup of this form. It bifurcates the amount in two parts, amount admissible and amount inadmissible. And I have come across audit reports where there's a practice that even if the amount is there is no amount under inadmissible section, then also the entire amount is mentioned here and the entire amount is mentioned under the section admissible. So if at all that is being done, then also there is no negative impact because there is no amount mentioned for inadmissible. That can be done, but the clause does not ask you to mention the amount if there is no amount mentioned as inadmissible under section 40B BA. So for this particular clause, we need to have working papers. What are the working papers we need to have? We need to have partnership deed. We need to go through the clauses which talks about the salary, remuneration. If at all, it has to be paid only to a working partner. So if we have to make sure that the remuneration, whatever is being paid, it is only paid to a working partner. Next point, the interest portion has to be seen. There cannot be, if at all interest portion, if at all interest is mentioned more than 12%, the same will be disallowed. So go through the deed, find out, take a MRL, if at all it is required, you see, management representation letter, that what is the interest rate on which, interest rate on capital you have provided to the partners. If it is exceeding 12%, the same has to be disallowed. Make sure you have all the working papers in place for these clauses. Disallowance deemed income under section 40A3. 40A3, a very important section which talks about that any expenditure, if it is paid in cash exceeding 10,000, then you are in trouble, the same will be disallowed. Earlier, this threshold was 20,000. The same has been reduced by this new government to 10,000 as we all are promoting digital economy and digital cash system. That's why this amount has been reduced to 10,000. Any expenditure, if at all it is being paid in cash exceeding 10,000 in a particular day against a bill, the same will be disallowed. There are certain, exceptions where this particular payment might increase and still disallowance will not happen. Suppose there is a bank holiday and it is a kind of mandate and it is quite essential for your business that you have to pay, and there is no other means to pay, then it is disallowed. And in villages where there is no proper infrastructure to comply with this particular section, in those cases, there can be a deviation from this section and still it will be allowed. The limit for payment to transporters is 35,000 and 10,000 in any other case. So keep that in mind. You can take an MRL. MRL will not suffice the purpose. How you can check it? If at all the account is being maintained in Tally, what you can do is you can open the cash book in Tally. There you go through the daily payment, make the changes where the daily payments are seen and put a filter that any payment exceeding 10,000, please filter those transactions. Those are the transactions. Now examine those transactions if those transactions are in the nature of business or not. If it is in the nature of revenue nature, then the same will be disallowed. So make sure you examine the cash book. You can take a management representation letter, but that will not suffice because you need to have corroborative evidence. So you go to the cash book, filter the cash book. After filtering the cash book for payments more than 10,000, examine that what are the payments which are in the nature of capital expenditure and revenue expenditure. If at all there is some capital transactions, the partner has introduced capital in cash exceeding 10,000, then there can be a scenario. It is not there's something it need not be disallowed. But if there is a revenue expenditure exceeding 10,000, then the same will be disallowed. Make sure. Even in case of depreciation, in case of assets, if a payment has been done in excess of 10,000 in cash to purchase any particular asset, get the bill, check the payments in a particular day. If payment has been done exceeding 10,000, the same will be disallowed. You might come across a scenario where generally the bill of a particular purchase or a particular revenue item in PL is of 50,000, 60,000, 80,000. But the payments can be broken on multiple days, which is not exceeding 10,000. Friends, this is allowed because against a particular bill, payment is not done on a single day. Payments are being done on different days, not exceeding 10,000 against a single bill. this is allowed and you did not disallow it. Again, I'm reiterating this, that for a particular bill exceeding 10,000, there can be a payment till the amount of 10,000 on different days. And this particular expenditure will not be disallowed. So you have to make sure that the payment on a particular day to a particular party against a single bill should not exceed 10,000. So if there is a bill of 80,000 and if the person concerned is paying him on 8 different days of 10,000, then this will not be disallowed. D, capital A, on the basis of examination of books of accounts and other relevant documents evidence whether the expenditure covered were made by account pay check, drawn on a bank or account pay. If not, please furnish the details. So the answer is yes, if everything has been complied. It talks about if not, if the same has not been complied, please furnish the details. If it has not been done through account pay check or bank account paid bank draft, then please furnish the details. Clause B talks about on the basis of examination of books of accounts and other relevant documents, whether the payment referred to in section 40A 3A were made by account pay check, drawn on a bank or account pay bank draft. If not, please furnish the details. So what is the difference between A and B? Here it talks about account payee, and here it talks about were made by account pay check. If not, please furnish the details. Amount deemed to be the profit and gains of business or profession under section 40A 3A. So I'll just examine 3A once for you. So 3A is a specific section which talks about that now there was an expenditure which was standing as a sundry creditor in your account, and if you are paying the same in the current year in cash, then also this will be disallowed. So you are not supposed to pay even in case of creditors are there. There were creditors in your books, and if you are paying them in cash, then also this will be disallowed. 3A and 3 are two different sections which talks about that whatever expenses are there, which you have been paid in the current year, exceeding 10,000, the same expenses will be disallowed. Now there were sundry creditors against the expenses, which there was no clarity that how are you going to pay, because these are sundry creditors. And if in the current year you are paying them in cash, then though prima facie it looks like that it is a capital expenditure, it is a capital expenditure because it is hitting your balance sheet. But since you had already taken these expenses in your PL and you had got the benefit of allowance under Income Tax Act, so you're not supposed to pay your creditors even in cash in the subsequent years. 40A 3A talks about of the payments in the subsequent years. So any expenditure, even if it is unpaid during the year, outstanding, and the same is being paid in cash in the subsequent year, the same will be disallowed. Provision for payment of gratuity not allowable under section 40A7. Now, what happens that if the number of employees is more than 10, then gratuity is applicable. There have been scenarios that gratuity is applicable, but there is no payment or there is no provision for payment of gratuity. My dear friends, take a management representation letter that how many employees are there in your organization. If at all it is exceeding 10, then ask for that if there is any gratuity fund which you are maintaining. Because as per gratuity, what happens in gratuity fund, that they open a separate entity as gratuity fund for employees, and the gratuity fund, whatever amount is invested in the gratuity fund, the same is invested through LIC. In the most cases, it is invested through LIC. So what happens that a particular provision is done for gratuity, and the same amount is given to LIC for investment. Once an employee retires or leaves the job, the same LIC pays the amount of the gratuity to the employee. And we have already, we know the calculation of gratuity also, and gratuity, how the exemption to in gratuity is done. Now what happens, what this section says, that if you are maintaining a separate entity for gratuity fund, then the same gratuity fund has to be registered under Income Tax Act. If at all it is not registered under Income Tax Act, then whatever expenses or provisions you are debiting in your profit and loss account in the name of gratuity payment, the same provision will be disallowed under Section 48(7). So friends, what are the things you have to make sure? You have to make sure that how many employees are there in the company, in the entity, organization. If at all it is exceeding 10, ask them if they are maintaining gratuity or not. They should maintain gratuity. They are supposed to maintain gratuity. If at all they are not maintaining, give an adverse comment that the entity was subject to maintenance of gratuity fund, but they are not maintaining any gratuity fund for the employees. If at all they are maintaining gratuity fund and they are registered under Income Tax Act, ask for the registration certificate of Income Tax Act, that whether you are registered under Income Tax Act or not. If these things are met, then there will be no disallowance. If any of this is not met, and despite there might be, this particular section will trigger when that they are maintaining a gratuity fund, but the same is not registered with Income Tax Act. And on the top of that, they are also mentioning a particular provision for gratuity in the PL. In that case, this particular provision for payment of gratuity will be disallowed, and the same has to be mentioned in clause E. Clause F talks about any sum paid by the SSC as an employer not allowable in Section 40A(9). So there are different funds. If those are not registered provident funds, and if the employer is providing that fund in that particular provident fund, it will be disallowed. So the department wants to make sure that if at all the employer is doing any good for the employees, it has to be done in a legal manner and to all the registered funds. There cannot be a fund which is not registered, because there have been cases where scams have happened, that they are simply siphoning off the money, that a particular fund is there for the employees fund, but the same fund is not registered anywhere. And the fund of that, the entire amount of that particular fund are being used by the directors themselves. Particulars of any liability of contingent nature, you can take a management representation letter, as well as you have to examine in the, as a chartered accountant and as an auditor, that if a particular liability is of the contingent nature or not. Provided, make sure generally no entity books any expenditure which is in the nature of contingent nature. If at all they do it, go through the accounting standards and examine those particular expenses, that if any liability is there, if any expense is there in the nature of contingent nature, mention it. Now, generally, this particular clause is also tricky. What happens that people tend to mention the contingent liability of contingent nature, even in cases they are not part of financial statements, because liability of contingent nature, if it is part of notes to accounts, then also people tend to mention it in the liability of contingent nature, and that is not the intention of the legislation. Intention of the legislation is that if at all it is a part, then only you mention it. If it is not a part, because the heading of clause 21 talks about debited to PL. If it is not debited to PL, there is no requirement to mention the same. So please make sure that do not go out of the way to report things which are not the part of your financial statements. Make sure that whatever is being asked, report to that extent only.
Sorry to interrupt, sir. Slide is not getting changed as per the topic. We can see clause 21B only on the screen.
Is it? Okay.
Yeah, now perfect.
Can you see it now?
Yeah, perfect.
Okay. Okay. So section 14A and rule 8D talks about that if at all you have investments and those investments can give you income which will be exempted, then in that case, 1% of the average monthly balance and yearly balance will be disallowed as expenditure. Now, what is the concept of section 14A? It talks about that if you have any exempted income, then obviously since the income is exempted, then whatever corresponding expenses are incurred to earn that income, those have to be disallowed. That is the thumb rule, that if there is any income which is exempt under Income Tax Act, then whatever expenses are there to earn that income, that will be disallowed. Fine. Somehow, there is no income in your current PL for this particular year, which is exempt. But This particular section 14A has been amended in, I guess, Finance Act 21. I'm not sure about the year, but recently it got amended 21 or 22, where it talks about, because it was a litigated section throughout, and it talks about that even though the exempt income is not there in your financial statement, in your profit and loss account, in your case, then also annual average of the monthly average of the opening and closing balance of the value of investment from which exempted income can come, 1% of this average will be disallowed, even if there is no exempt income. So somehow this looks, kind of too harsh, but that is the law of the land, and that has to be complied with. And earlier there were judicial pronouncements which talks about that if the income is not there, then there is no need to disallow 1% or 0.5%. But now, since it is a part of the law, then the same has to be taken care of, and the same has to be disallowed. Make sure you take the list of the investments from which there can be an income which is exempted. Earlier, dividend was there. So for all the investment in shares where dividend could have come, those shares were being taken. Now, if there is investment in any private, private company, I guess dividend is not there. So dividend is anyhow taxable. So that particular class of investment I cannot foresee right now. But if at all you foresee any investment in your financial statement, in your balance sheet, and from that investment you can see an income which can be exempted, then the annual average of the monthly average of the balance of the investment has to be taken, and 1% of that has to be disallowed. So 21H was about disallowance. 21I, any amount of interest paid in capital borrowed. So clause 21I talks about that capitalization of expenditure is there or not. If there is an expenditure which was supposed to be capitalized, if it has not been capitalized and has been debited to PL, the same has to be mentioned in clause 21I, and the same will be disallowed. Now, there was a plant, and for the installation of that plant, you took loan. Now, during the period of installation of the plant, whatever interest you will be paying on that particular loan, ideally that has to be capitalized. But if it is not capitalized and it is booked in your PL as revenue expenditure, the same will be disallowed. So for this, you see that if at all there is a fresh loan taken in your case, in your financial statement, see the application of the loan. If the particular loan has been disbursed to buy a particular capital asset or installation of plant and machinery, then see that to what extent the interest has to be capitalized and by when the plant and machinery started operating. Because before operations, and if at all the plant and machinery has been installed and no operation is started, or till the date the plant and machinery was being installed, till that date the amount has to be capitalized. So it talks about was borrowed for acquisition of the asset till the date on which such asset was put to use shall not be allowed as a deduction. Now, in this case, there is a tricky scenario that the asset has been installed, but the factory has not started. That means what? The asset has not been put to use, the plant and machinery has not been put to use, and you have been paying interest on the loan because the loan is already there. In that case, it talks about since till the date asset is put to use, till that date, the entire interest has to be capitalized. Once the factory has started and the plant and machinery has been put to use, then only you will get the benefit of interest in your PL account as revenue expenditure. And what happens to the capitalized expenditure? You will be getting them as the plant and machinery capital will increase, and the same benefit you will get through depreciation. Clause 22. Any interest payable to MSME. What does clause 22 talks about, and what is the importance of this MSME payment? The government of India wants the MSMEs to grow. What is MSME? Micro, small and medium enterprises. So these are the enterprises which act as the backbone of the economy. Now, the government of India wants the bigger players to pay them at the earliest. So they do not want the payment to MSME should be outstanding by anyone, should be kept as outstanding. That's why the government of India has proposed in MSME Act that if you are holding the payment of MSME for more than 45 days, then you are supposed to pay interest at 3 times the rate notified by RBI per month. So this is a huge penalty. It is not a penalty, but it is in the nature of interest. But you have to pay 3 times the rate notified by RBI per month to MSME for the amount outstanding. Now what happens? You are paying interest because you have not paid the principal amount to MSME. You had kept them due. On the top of that, Income Tax Act says that whatever interest for this particular non-payment to MSME has been incurred by you, that particular interest will be disallowed. So you see the double-edged sword that first of all, you have to pay interest to MSME 3 times the rate notified by RBI if the amount of outstanding is more than 45 days. Now on the top of that, the same interest will be disallowed also. And the same has to be mentioned in clause 22. It only talks about that amount of interest inadmissible. So if at all there is any interest, then the same interest has been booked in profit and loss account. The same will be inadmissible. Now, what are the working papers we should have for this clause 22? Generally, the vendors who are MSME, they inform the entity that I am a MSME, so that your SSC or your client comes to know that it is a MSME and the payments have to be released within 15 days to 45 days at the earliest. Now, in case the vendors of your client have not informed that they are MSME, and if you have inquired them that please confirm if you're MSME or not, and they have not replied, then there is a benefit of doubt which can be taken that since the vendor has not informed that whether it is a MSME or not, and that's why it cannot be concluded, then there is no question of interest, and if at all the payment has been delayed or not, and there is no question of disallowance. If at all the party has confirmed that yes, I am a MSME, then make sure the payments are done. Now another thing, the payments are done, then also the MSME has not asked for any interest. It is a mutually accepted thing that though you have made a late payment by more than 60 days, but still I'm not asking for any interest. Then there are two views on this, that should we make provision for interest, because as per Act, I'm supposed to pay interest. But since the party has waived me the interest, then there is no question of interest, if at all. Now there is a second opinion which talks about that there might be a scenario that they have not discussed about the payment of interest. And since they have not discussed about the payment of interest, the concerned SSC should make the provision of interest, and they should make the provision, and after making the provision, we will disallow it. In my opinion, in my personal opinion, if MSME has not asked for interest, entity is not required to make a provision for interest, because that is not the bone of contention anymore. And since there is no interest in the PL, so there is no question of disallowance. That is my personal opinion for clause 22. Clause 23 talks about payments made to related party, RPTs, in short form we say, related party transactions. Who are these related parties? Section 48(2) gives a list of related parties. As an auditor, we are not supposed to, and we cannot know that who are the related parties of our client, of our SSC. In that case, take a written representation from the client that what are the transactions you have undertaken during this year with related parties, verify them, make sure that those transactions are done at arm's length price. That is the first thing as an auditor you should do. Next thing, whatever transactions have hit the profit and loss account, and those payments made to related parties are hitting your profit and loss account, please mention those payments in clause 23. So if at all any salary is being paid to the wife or son, or the son of the director, make sure that you mention it in clause 23. Clause 24, deemed profit, section 32 AC. Clause 32, 33, section 32, 33 AB and ABA These are sections which talks about tea, rubber, coffee, site restoration fund, shipping business. And these are the sections which generally we do not come across. But for tea, rubber, coffee, there is a separate section and there is separate taxation. We have to make sure that if at all you have any deemed profit, these are the sections which talks about deemed profit, like 15% deduction is there for investment in plant machinery, section 32 AC. So if at all deemed profits are there, those particular profits have to be mentioned in clause 24, especially in case of tea, rubber, coffee and site restoration fund. If at all you have any clients, you have to compute the profit in pursuant to those sections, you have to mention them here. Clause 25, any amount of profit chargeable to tax under section 41. Now what happens? That you had claimed a particular amount as bad debt in a particular year, or loss in a particular year, in some previous year. And fortunately, luckily, the same party has come and paid you in this current year. What should be the taxation of this? Since you have already claimed the same amount as bad debt in past year, that means you have not paid taxes to the government on that particular amount. And now since you've received the amount in this current year, the same has to be offered for tax in the section 41. So that is one thing which will be covered under section 41. If at all you have received any amount which was in the nature of liability or loss which was booked in the PL of previous years, and current year if you have received, please book it here. Profit in case of power sector assets, clause 41, clause 25 under section 41, bad debts recovered. So those are the amounts which have been recovered by you in the current year, that has to be mentioned in clause 25. Clause 26, another important section and most widely filled clause in our tax audit report. It talks about section 43B expenses. What is section 43B and what is the concept of section 43? Government of India talks about that, look, maybe you are maintaining your books of accounts in an accrual concept. Then also, there are certain expenses which need to be paid before claiming the expense. Who are the parties against whom you are incurring these expenses? Generally, the government, the banks, the NBFCs, the railway. What they are saying is that if you are trying to claim a benefit of payment of tax or ESI, PF, or payment of freight to railways, and you have kept it as outstanding and not paid, since you have not paid it, then you will not be allowed the benefit of this expense. Because government is saying that you have already not paid it to me. On the top of that, you are getting 30% benefit by booking it in PL. That cannot happen. Pay me and then get the benefit. That is the concept of 43. What does 43B talks about? Any tax duty, sales tax, VAT, service tax, by whatever name called, payable by the SSC under any law for the time being in force. Then it talks about employer shares, employer share of ESI and PF, bonus or commission payable by the SSC to its employees for service rendered, interest on loan or borrowing to public financial institution, to NBFCs, then payment to railways. Now, my dear friends, the question is that with the advent of GST, in most cases, if it is not a case of composition scheme, GST is a balance sheet item. And since GST is not debited in PL, do I need to disallow it or allow it? Because since it has not been debited to PL, where is the question of disallowance? My friends, though GST being a balance sheet item as per accounting concept, but section 145(1) is there, which talks about inclusive concept of accounting for income tax purpose, where all the taxes have to be added for calculation of inventory. 145 is there. Department stand is, and there has been several case laws, especially I guess Chaurangi Sales Corporation case law is there, and recently a tribunal has also given, I guess Varanasi tribunal has given a judgment that even though GST has not been booked in PL, but since section 145 talks about the inclusive concept, and by using that inclusive concept, whatever GST payable was there, That is, when I say GST payable, it means GST output minus GST input during the year. So this is the amount which was GST payable for the SSC during the year. The entire amount has been paid during the year or till the due date of filing of return or not. If that has not been paid, that will be disallowed even though it has not been booked in PL. So my dear friends, for this, make a working, especially for GST, I'm talking about that whatever GST is there, GST output minus input, you'll get it from cash ledger generally. Whatever cash ledger is there, the cash ledger has to match with your books of accounts. And in most of the cases, GST cash ledger for till the month of February, you will see that that has to be, everything has been paid till March. Make sure that the March GST cash ledger is paid before the due date of filing of return, that is, or before the date of filing of tax audit in our case, because it is, you have to comment on the date of tax audit, that before the date of tax audit it is paid. If it is not paid, then the same will be disallowed. An example I can tell you that suppose by deducting GST output minus input, you get an amount of 1 lakh for the entire year. Out of this 1 lakh, 30,000 was outstanding dues for March. So 70,000 was the liability from April to February, and the same has been paid in a due manner. This 30,000, if it is not paid, then the same will be disallowed and it will be added back. And what you have to mention in this, section 43B talks about that the entire expenses, whatever expenses were incurred during the year, the same has to be mentioned and commented whether the same was paid during the year or till the date of filing of return or not. So in your case, if 1 lakh was the entire GST payable from cash ledger for the relevant financial year, and the same has been paid also, then this amount of 1 lakh has to be mentioned here. Generally, there is a practice that what people do is that only the amount outstanding, that is for the month of March, whether that is paid or not, they mention it here. In my opinion, since the entire amount was payable and the same has been paid during the year or till the date of filing of return, the entire amount has to be mentioned here. The same goes for ESI and PF. Here you have to mention the relevant portion of the employer only, employer share of PF and ESI, which has been incurred during the entire year. If that has been paid during the year or till the date of filing of return, mention it here. The same goes for interest on loan. The entire amount of interest on loan which has been incurred, make sure it is paid through the bank. And for this, you take the ESI PF ka chalan, you can take. For taxes, you can check the cash ledger on GST portal. For interest on loan and interest on loan to NBFC, check the, get a, confirmation from the bank itself, and check the statement of the client also in Tally or in whatever accounting software they are using for that particular loan, that whether the same has been paid or not. Even if it is shown as paid, make sure that you get it in the bank statement also. So these are the working papers you should maintain for clause 26, that is section 43B. Clause 27A, details of SENVAT and its treatment in PL. Look, it talks about SENVAT, and since it does not talk about GST input, so guidance not on tax audit has taken a stand that since they have not mentioned it specifically that we have to discuss anything about GST input, so that's why SENVAT in the current scenario it is not there applicable. If at all it is applicable in your books, you can mention it here that SENVAT availed, that at the time of passing journal it is being availed, at the time of payment it is being utilized. The difference between SENVAT availed and SENVAT utilized I'm discussing here. But in most of the cases, SENVAT is not applicable. So it is the discretion of the auditor if they want to mention here about input tax credit availed and utilized. Generally, if it is interpreted in a nice and noble manner, then you can say that, okay, if it is SENVAT is not there, since GST input is there, then GST input availed and utilized, should I write it here? My answer is that you'll go out of the way if you are complying with that, but yes, you can do it. But the clause is not asking for GST input. It only talks about SENVAT. Clause 27B talks about prior period expenses and incomes. If at all it is there in your PL, you mention it. and take a MRL, management representation letter, for prior period. Clause 28. Clause 28 talks about whether during the previous year the SSC has received any property being share of a company, not being a company in which the public are substantially interested without consideration or for inadequate consideration, as referred to in section 56(2)(7)(a). So, if at all you are receiving any share, if you are an SSC and receiving a share of a private limited company, and the valuation of that share, we have to check whether it is in line with or not. How will you check? If suppose in your investment side of your balance sheet, there is a new item, investment in shares of ABC Private Limited. Now, this is a case where clause 28 will trigger. How are you going to examine whether the same has happened at the correct value or not? There is a certification called Rule 11 UA, under which the valuation is done for transfer of shares. Now, since your client has received shares, their valuation under Rule 11 UA has to be done, and you have to make your comment whether the value on which the shares have been acquired by your client, the same value is mentioned in 11 UA or not. If it is not mentioned, then the differential amount will be taxed. The value as per Rule 11 UA, it says that it has to, the fair market value of the shares is ₹100, and if you are buying the same at ₹80, then there is a problem, because Rule 11 UA and 56(2)(7)(a) says that if there's a differential amount, the same will be added back. So that's why if there is a new item in the investment side of your client, of your balance sheet, then make sure that you get the valuation certificate under Rule 11 UA for clause 28, and make sure that the shares which have been acquired by the SSC, it is at the same rate which has been found, which has been calculated as per Rule 11 UA. Clause 29. Whether any amount is to be included as income chargeable under the head. No, 29, first of all, it is 29A. 29 talks about whether during the previous year the SSC received any consideration for issue of shares which exceeds the fair market value of shares as referred to in section 56(2)(7)(b. If yes, please furnish the details. So it is only applicable for private limited company, because who can issue shares? Private limited companies. So there is a scenario where private limited companies, your SSC is a private limited company and they are issuing shares. For private limited company, for issue of shares, again Rule 11 UA is there, as well as valuation concept under Companies Act is there. The same has to be in line with that valuation. If you are issuing shares at a price other than that valuation, then the same will be taxed. Now, there is an exception for the startups. Registered startups are there which can issue shares at any given price, and there is no bar and there is no limit on the valuation. And that is specifically mentioned in section 56(2)(7)(b) for startups. Clause 29A, whether any amount is to be included as income chargeable under their income from other sources. 56(2)(9) it talks about. What does section 59(2) talks about is that advance forfeited in case of capital asset, whatever advance is there, if at all you got into an agreement for sale of capital asset, land and building. In your case, you got into an agreement with person A. You took an advance of ₹10 lakhs, and there was an agreement that after 2 months or 3 months, the entire amount will be disbursed by the buyer, and the buyer failed. And there was a clause in the first agreement of sale itself, that if within 3 months the other person will not be able to pay, then the entire amount will be forfeited. Since the person has failed to pay, then this entire 10 lakh has been with you. That particular 10 lakh has to be mentioned here in clause 29A. 29 capital is small a. Whether any amount is to be included as income chargeable under the income from other sources, 56(2)(9), and then B is nature of income, amount thereof. Then 29 capital B small a, it talks about 56(2)(10). What is section 56(2)(10)? 56(2)(10) talks about that if you are receiving any money, any asset at a price other than the fair market value. So you are receiving a capital asset or a building where the differential amount is, okay, asset worth 1 crore, you're getting it for 50 lakhs, then this 50 lakh has to be added under section 56(2)(10). That is the sum total of 56(2)(10). And this particular section acts as a kind of, though it is a particular section, but it is more of a penalty in nature. Suppose, where will it trigger? I'll tell you. That you have received gift from your friend of 2 lakhs. This particular section will trigger. Because there is no consideration against which you have received 2 lakhs. You have simply received 2 lakhs from your friend as a gift. This particular section will trigger. For gift from relatives and at the time of marriage, this particular section will not trigger. But apart from those 2 instances, everywhere it will trigger. Make sure that do not receive gift. Since we are discussing gift, make sure you do not receive any gift in cash in more than 2 lakhs, even from your blood relatives. If you receive gift in cash from your blood relatives in an amount exceeding 2 lakhs, then there is a separate section which will trigger, that is section 269 ST, which talks about, it is a section penalty in nature, which talks about that whatever amount exceeding 2 lakhs, if you are receiving in cash from a single person in a single day, then that entire amount will be taxed as penalty. Because the government of India doesn't want you to deal in cash. So even in case of marriages, if you're doing any planning or something, make sure that you do not show a gift amount of more than 2 lakhs in cash from a single person, because it is an event, and for a particular event also that particular section will trigger. So 56(2)(10) talks about the transaction where any capital asset has been taken, or there has been cases of gift in an amount exceeding 50,000. Make sure this particular section will trigger. Take a representation from the SSC, especially in case of sale of assets or purchase of assets. Suppose the asset has been purchased by you. Now the stamp duty value of that particular asset is 1 crore and you purchase it for 60 lakhs. Then this differential amount of 40 lakhs will be taxed. So what are the working papers you should have for this? If there is any purchase of new asset in your case, in your SSC's case, get the purchase deed of the asset, find out the stamp duty value. If that property is registered, you will get the circle rate also from the client. Make sure that the transactions should have happened at circle rate. If it has not happened, then the differential amount, if your client has purchased this property at a lower rate, whatever is defined in the stamp duty rate, then the differential amount will be taxed and the same will be mentioned here. So you should have 2 working papers, the purchase deed and the circle rate valuation. Clause 30. Details of amount borrowed on hundi. Hundi is not popular these days. So if at all the amount has been borrowed on hundi, for this also you can take a MRL or amount due thereon, including interest thereon. This particular section, clause 30, is applicable. In most of the cases, I have not come across any audit report where clause 30 is filled these days. Clause 30A, small a. Now this talks about international transactions. Let us understand the concept of this transaction and then we will get into the clauses. Whether primary adjustment to transfer price as referred to in subsection 1, 92C has been made during the previous year. What is this primary adjustment? When there is a concept of associate enterprise. So what is associate enterprise? Now you are a company in India and you have a subsidiary in England, London, and you are selling your products to London. So if at all, I'm just taking an example that the tax rates in London is quite low and tax rates in India is quite high, then it is human tendency to transfer your profit from India to London so that lower taxes are paid in London. For this, there is an organization called Organization for Economic Cooperation and Development, OECD, and there is a concept called base erosion profit sharing. What does it talk about? It talks about is that whatever income has been accrued in a particular country, the taxes on the same has to be paid in that country. And there should not be any avoidance of tax by illegitimate planning. So the company situated in India will try its best to transfer the profits to London because tax rates in London is low. Now, Government of India and the transfer pricing rules in India says that whatever amounts, whatever transactions are happening between a country, between an entity in India and between an associate enterprise of the same entity abroad, it has to be done at an that if you are selling product A to an entity in South Africa at price X, then to your associate enterprise also should transfer the product. You should transfer the product at price X only. Now, if you're trying to transfer your profit and you're trying to book lower profit in India by transferring the product A at lower than X to London, and London entity will sell it further at a higher price, then that is not acceptable in India. So what is happening? That a product worth 100 rupees or a product worth 100 rupees was sold to Africa, and the same product is being sold to London at a 70 rupees. So what is happening? In India, for the product sold to associate enterprise in London, there will be lower profits. This is one of the examples I'm giving you. So Government of India Income Tax Department is saying that no, you will have to revise your price to 100, even for the products which you have sold to your London entity, your associate enterprise. For that, the person concerned, the entity in India, will have to make primary adjustment in transfer pricing. That since you have sold to an independent entity in Africa at price 100, now since you are selling it at 70 rupees and you're trying to reduce your profit by selling at a lower price to your London entity, you have to increase the price to 100. This differential of 30 rupees is called primary adjustment. That is the concept of primary adjustment. Now coming to clause. Whether primary adjustment to transfer prices are referred to in subsection 1 of section 92C has been made in the previous year. If at all, how is it made? There can be a scenario that there is self-realization that, okay, you are finding it difficult that, okay, fine, there was some goof up while deciding the transfer price. So that's why I'm making it on my own. There can be a scenario where there is a case of advanced pricing agreement or mutual agreement procedures are there, map is there. And there it is decided that, okay, fine, this particular product will be sold at this particular price, your associate enterprise. So under that, primary adjustment will be done. Or there is this, the TP officer has come up with an order which talks about that the primary adjustment has to be done. Now, under these circumstances, primary adjustments are done. So you have to do primary adjustment. What it talks about is, if yes, please furnish the following details. Under which clause of subsection 192C? I mean, why have you done it on your own, or APA is there, or MAP is there, or the officer has forced you to do this? What is the amount of primary adjustment? Now, whether the excess money available with is required to be repatriated to India as per the provisions. Now, this excess money, now since you have revised your price from 70 to 100, that means what your London entity is supposed to pay now 30 rupees extra because you have sold the product to them at 70 rupees. Now, the Income Tax Department of India is saying that no, don't sell it at 70 rupees, but sell it at 100 rupees. So additional 30 rupees is something which you're going to receive. The Government of India is saying that you are supposed to receive this 30 rupees within a span of 90 days. I'm not sure, I guess it is 90 days only. Within 90 days, the same has to be received by India. If at all it is not received by Indian entity within 90 days, then Indian entity is supposed to charge interest on the same. Are you getting my point? You have to charge interest on the same, and the rate is SBI plus, I guess, 5% more. SBI rate plus 3% more if the amount is denominated in INR, and it is LIBOR plus some percentage where the interest has to be received. I mean, the interest has to be calculated and the same has to be charged from your foreign entity as a penalty. Though I'm saying the word penalty, but it is not penalty, but it is a kind of benefit which the Indian government is saying that since each and every government wants Forex to be with them. Now, after doing the entire exercise, if I find out that, okay, my 30 rupees is lying with my London entity, and in case of global economy, and in case of Indian economy, Indian government will always want just 30 rupees, which is in terms of USD, if at all, that 30 rupees should come from London to our country. And if at all the Indian entity is not bringing that money back, that means what India is losing its revenue. And since it is losing its revenue, I mean, that money is not being rolled in the economy. So that's why they are saying that, okay, fine, since you're not bringing that money into Indian economy, the Indian entity will have to charge interest on that amount. When this will trigger? If the excess amount whatever the primary adjustment amount is there, that is exceeding 1 crore. Then this entire income, the concept of entire interest will come into picture. Hope this makes sense. Clause 30B. It also deals with international taxation. Whether the SSE has incurred expenditure during the previous year by way of interest or of similar nature exceeding 1 crore rupees, as referred to in subsection 94B. So it talks about that if at all a particular entity in India is paying interest exceeding 1 crore, international transaction is there, interest to non-resident exceeding 1 crore, then this particular section clause will trigger. What is happening? It talks about that there is a concept of EBITDA. And what is EBITDA? Earning before interest, tax, depreciation, and amortization. It says that if your amount, first of all, we'll have to find out EBITDA. Then find out what is the 30% of EBITDA. If your country in India, your entity in India is paying interest to a non-resident of an amount exceeding 1 crore, then in that case, 30% of EBITDA is the maximum which will be allowed. 30% of EBITDA. If your interest amount is more than 30% of EBITDA, if your amount is more than 30% of EBITDA, that means what? Again, that concept of base return profit sharing, and you're trying to, shift your money here from India to foreign. That is the concept. So they are saying that, okay, fine, you are paying interest of a huge amount. You are paying huge amount as interest to a non-resident, and it is exceeding 30% of your EBITDA even. So whatever interest amount is there, you pay it, but we will allow to the extent of to the extent of 30%, and rest of the amount will be disallowed and will be carried forward for 8 years. Rest of the amount will be carried forward for 8 years, and if interest amount comes down, then you claim these amounts just the way losses are being claimed, that in this particular year there is an upper cap. The upper cap is this one, and after that, whatever amounts are being not allowed, you carry it forward for 8 years. The same interest will be allowed. Why these actions are being taken? These actions are being taken so that huge money as interest are not paid to non-residents. If at all it is paid to non-residents, then the same has to be disallowed. True, and all these guidelines have been come into picture. OECD has, come up with guidelines and directions that this is how we should trigger these points to avoid base erosion profit sharing. Clause 31. Clause 31, another important clause which has been widely filled by all the auditors. It talks about, generally the common concept is that if at all there is a loan, the loan is being taken and the amount of that loan is exceeding 20,000, then this particular clause has to be filled. That is the general understanding. Now, my question is that is it only applicable in case of loan? Answer is no. It is also applicable in case of specified sum, where you have taken as an advance for sale of property, capital asset, land and building. You have taken an advance, and if that advance is exceeding 20,000, then also this particular clause has to be filled. What needs to be filled? Name, address, and permanent account number, amount of loan or deposit taken or accepted, whether the loan or deposit was squared up, maximum amount outstanding, whether the loan or deposit was taken accepted by check, in case the accepted by check, whether the same was accepted by an account pay check or account pay bank draft. So it talks about that a person in India is not allowed to take loan in cash exceeding 20,000. If someone is taking loan in excess of 20,000 in cash, the same will be disallowed and penalty of the equal amount will be imposed. So this particular clause will cater to that requirement. And once you fill this particular clause in the manner it is intended to, then the income tax department will get all the amounts which has been taken as loan in excess of 20,000 in cash, and they will impose penalty on the same. Make sure how to go about it. Take a list of all the loans from the parties with whomsoever they had taken loans. And in this, do not go for loans which have been outstanding during the year only. Go for the full year. There might be a scenario where the loan was taken during the year and the same was paid also. So make sure whatever loans have been squared off, taken during the year as well as squared off during the year, the same also need to be reported here. If at all there is a case of opening loan was there and the same has been repaid during the year, those things also need to be reported here. And opening loan was there during the year also, some transactions have happened and closing is there. Since there is closing balance, those things we get to know. What gets missed is that if at all the loans have been taken during the year as well as repaid during the year, those things get missed. So make sure those things also get reported here. Now another thing, how this maximum amount outstanding. Friends, in Tally, there's a concept of that daily reporting is there. Go through the daily reporting, whatever the maximum amount is there in the daily reporting, that is the maximum amount outstanding. In this case, one, unique scenario is there where the opening balance might be the highest amount. And after that, generally we tend to skip that. If the opening balance itself is the highest amount, we tend to skip that. Please don't skip that. There might be a scenario where the opening amount itself is the highest amount. Mention that amount outstanding in the account at any time during the previous year. The name is there, address is there. What are the working papers you should have? Who from the persons whomsoever you have taken loan from, make sure you get the name, address, and PAN. I guess the Aadhaar and PAN card itself is there, then that is the best thing to happen, because from Aadhaar you will get the name and address, and PAN card you will get the PAN number, permanent account number you will get. Amount of loan or deposit taken or accepted. For this, one thing also I'll suggest that try to take a confirmation from the parties. Go for confirmation from all the parties, and if at all, the number of parties is long, the list is long, try to go for samples and ask for the party confirmation, external party confirmation from your client that they should mail the auditor, the party, whatever balances are there. It is a must which you should practice so that the amount gets matched. So for all the amounts outstanding, even if during the year there has been some transaction, you have taken some amount in bank or in cash, mention it. Clause B talks about specified sum, that if you have taken any specified sum, taken or accepted during the year, name, address. What is the specified sum? Specified sum is the sum against, that is as an advance against property. And particulars at A and B need not be given in case of government company or banking company. So if you're taking this loan from a banking company, then this need not be filled. But they have only mentioned banking company. So they have not given any relief to NBFC, though they have, wherever they intended to mention NBFC, they have mentioned it. And since they have not mentioned NBFC, and if there is any loan from NBFC, Tata Capital is there, whatever is there. So those loans also need to be mentioned here, because they have not given any relief for NBFC's company. Then clause BA, particulars of each receipt in an amount exceeding the limit 269 XT in aggregate from a person. Look, BA, what I was discussing, it talks about that if at all you have received in cash any amount exceeding 2 lakhs in respect of a single transaction, or in respect of transactions relating to one event or occasion from a person during the previous year, then such thing has to be reported. Why this has to be reported? What is the consequence? Whatever amount you have received exceeding, if it is exceeding 2 lakhs, the entire amount will be disallowed. So what I'm saying is that if against a single event or a single bill, the bill is of 3 lakhs and you receive the entire amount of 3 lakhs in cash, what is the outcome? 3 lakhs will be imposed as penalty in the hands of the recipient. Nothing is going to happen for the person who is making the payment, because that person might make payment in as his drawings. So if you are selling a TV and you are a TV shop owner, and if you are selling a TV which is the bill value is more than 2 lakhs, that is 3 lakhs, and someone has come to you and he is paying in cash to you, 3 lakhs entire cash. And if you're receiving it, then what is going to happen? This is a single bill and you're going to receive 3 lakh in cash. Entire 3 lakhs will be taxed in your hands as penalty. And the same has to be reported also. So make sure, go to your cash book, find out all the transactions where it is exceeding 2 lakhs. And if at all it is happening, then the same has to be reported here. Particulars of each receipt in amount exceeding the limit specified in 269 ST. Now another thing, though there are two opinions, the house is divided, but I will suggest that even in case of partnership firms, though there have been case laws which talks about that the firm and the partners are same, but to avoid any litigation and to be on a safer side, if the partner himself is introducing capital in the firm in the form of cash, make sure it is not exceeding 2 lakhs on a particular day. Because they might do it because they are saying that it is in the nature of capital, but section 269 ST does not bifurcate the transactions into capital or revenue. It simply talks about the transaction. If you're receiving in excess of 2 lakhs, the same will be taxed. This is to discourage cash system of transaction. And that's why this particular section has been introduced. Make sure that everything gets reported. And you also let your clients know that they do not get into any transaction where the amount is exceeding 2 lakhs for a particular bill or against a particular transaction. Clause 29BB talks about particulars of each receipt in an amount exceeding in aggregate from a person. So they have given different clauses where it talks about account pay check, account pay bank draft, and then it talks about received by a check not being an account pay check. So they are making a difference between account pay check and account pay bank draft. Now, clause C, it talks about repayment of interest. That is section 269T. When you're repaying the loan, deposit, or specified advance, or interest is also mentioned. If you go through the section 269T, it also includes interest portion. So if you're paying interest of rupees 50,000, and there might be a first prima facie understanding that this particular section is only talks about the repayment of principal. This is not the case. It also talks about loan amount and deposit amount and advance amount and interest. So if the interest is also exceeding 20,000 and the same is being paid, make sure it is not paid in cash. Otherwise, anyhow it will be reported and it will be reported in the clause where it will be disallowed. Particulars of repayment of loan other than by a check or bank draft. So we have discussed in clause 31, 3 sections, 269 SS is there, 269 ST is there, and 269 T is there. 269 SS talks about the loans which you have taken, the loans or deposits or specified sum which you have taken in excess of 20,000, everything will be reported. Whether the same is in cash or not, then also it will be reported. But if it is in cash, then there will be separate clause where it has to be filled. If it is normal in ECS, then it has to be filled in a separate clause. Similarly, in case of 269 ST, if there is a receipt of more than 2 lakhs, then the same has to be reported. Similarly, in case of 269T, in case of repayment of loan or deposit or specified advance, if it is in excess of 20,000, the same has to be reported. And the same is in cash, then it has to be reported in a different clause. Clause 32. Clause 32 talks about details of brought forward losses or depreciation allowance. Whatever brought forward losses are there, you can take a representation from the client also, as well as you have to verify the returns also, the returns of last 8 years to be on a safer side, that what are the losses which can be carried forward. Make sure the returns are filed within the due date and there is no appeal pending. If at all the appeal is pending, then the same has to be mentioned that this is already litigated. So we have to make sure that clause 32A talks about assessment year, nature of loss, amount as returned in rupees, and whether the losses are, with the advent of this new section 115B AA, BAC and BAD, that is 25%, and additional appreciation will not be allowed. if because of calculation of those sections, the loss carry forward has come to has fallen down, then you have to mention it, and amount as assessed. So amount as returned in rupees, whatever you have claimed, and clause 7 talks about if at all there is an order which has reduced your losses, the same has to be given, and you have to give in the remarks the detailed version of the order that yes, order dated this has reduced the particular amount of loss. 32B. Whether a change in shareholding of the company has taken in the previous year due to which the losses incurred to the previous year cannot be allowed. A very important section 79 which talks about that when the shareholding of the company changes and more than 50% of the shareholders do not remain the shareholder of the company, then the losses will not be carried forward. So that's why this particular section talks about whether a change in the share has taken place due to which the losses cannot be allowed. If more than 50% of the shareholders have changed, then these losses will not be carried forward, and this particular clause has to be filled. Clause C and clause D talks about speculative losses. What is speculative losses? The most common prevalent example is that if you are dealing in intraday, then that is a case of speculative transaction.
Sorry to interrupt, sir. Please change the slide. Yeah, perfect.
Details of deduction, clause 33. Clause 33, details of expenses, details of deduction in chapter 6 or chapter 3. So the list of all the deductions which are there, we will be covering it. And I'll just share this also. Can I share two screens at the same time? This new screen, can you see? Can this be seen? The new
yes, sir. Yes, sir.
Okay. So I cannot switch over the screens. Okay, fine. Okay. Clause 33 talks about detail if any admissible chapter 6 deductions are there. So friends, there is a confusion. Generally, this commotion is there and this query is there that we are auditing the profit and loss and business books of the SSC. And if he is claiming section 80C and all, should we mention those sections here in clause 33? In my personal opinion, since if at all the same is not being paid from the business books, you cannot, I mean, there is an option that you cannot, if at all you're not filling this, it is fine. Because chapter 6 deductions and those deductions are taken in the personal capacity and it is not taken in the capacity of a profit and loss statement or in the capacity of the business. So that's why that can be avoided. And wherever section 10A, 10AA and 80IC, those things are there for those sections, this particular clause can be filled. Clause 34, most widely filled clause, very important clause. What does it talk about? It talks about detailed calculation of TDS. It talks about that what are the expenses on which TDS is applicable, first thing. Then, I mean, what are the expenses on which TDS section was applicable? Then it talks about what are the amounts on which TDS was applicable. And then it talks about whether the TDS has been deducted on those amounts. And if it's yes, then whether the TDS has been paid on those amounts. Now, I'll tell you an example that how you go about this particular clause. Clause 34 generally talks about that you take the profit and loss account of the SSC. Against all the expenses, you put a particular section, if at all is applicable. That is any TDS applicable on this particular expense, if it is applicable, under which section it is applicable. Don't check for the threshold limit or for the limit or for the TDS applicability. Simply find out the section that for a particular type of expense, whether this particular type of expense is covered in a particular section or not, because that will give you the sum total, that will give you the total base amount that, okay, fine, for the contract expenses, this is the total expense which can be categorized as contract. So for all the expenses which is in the nature of contract, put section 194C for all the items of PL. Once you put, I'm just try to give you the working that how it has to be done. Once you do this, you will get to see that, okay, for 194C, that is all the expenses which are in the nature of contract, you get a sum total. Now, it is not a mandate that for all the expenses 194C will trigger, because there is the upper cap of 30 lakhs, then 30,000, then 1 lakh is there. if it is applicable or not. Then 1%, 2% is there for individual HUF and 2% is there for other individual HUF. So now, once you have found out that, okay, fine, this is the total expense which is in the nature of contract. Now get deep into those expenses and see that, okay, fine, what are the expenses which were supposed to get subjected to TDS and section 194C. Filter those expenses. Now you have got those expenses. Apply TDS rate if it is 1% or 2%. Now you have got the entire picture of 194C, that this was the total amount which can be categorized in the nature of contract. And after that, you got the figure of expenses which could have been subjected to TDS. And now you go and check 26Q. So first of all, you filter all the expenses, categorize the expenses in the nature of section, that under which section it can be categorized. Then you work on the rates part, that what was the TDS supposed to be deducted. After that, you go and see Form 26Q, 24Q, 27EQ, whatever is there, TDS, TCS, go and find those sections. What happens is that you take those forms first of all, and then you do the reverse calculation. Okay, this is on which TDS has been deducted as Form 26Q, and this is how it has to be done. Don't take the Form 26Q as the face value, because then you are losing your independence as an auditor, because now you're doing a reverse calculation. You're starting the calculation on the basis of Form 26A or Form 26Q or 24Q or 27EQ. Don't do that. Start from PL. Once you have done your exercise, then you go and check it, verified from Form 26Q and 24Q, that whether the relevant TDS has been deducted or not. After that, you comment. Because if you do a back calculation and back verification, this will never serve the purpose. Because what is being asked in this particular clause, you see, TAN is there, section is there, nature of payment is there. Nature of payment, then total amount of payment or receipt of the nature specified. Because of this column, you should have an understanding and you should be able to apply that particular exercise where the expenses have to be categorized under each type of contract, or whether it is in the nature of commission, that thing has to be done. And then total amount on which tax was required to be. This is also something that you have done. Total amount on which tax was deducted. This particular this particular serial number 6, this is something which you will get from Form 26Q, that whether the tax has been deducted or not. Generally, what we tend to do is that we start from Form 26Q and 24Q and we fill this column. Don't do that. Start from PL, categorize the expenses under different heads of section, then find out the total amount, then dig deeper and find out whichever was subjected to TDS, and then you go to Form 26Q to check whether the TDS has been deducted on the same or not. After that, you put your comments. Coming to the next part, one more thing, very important thing in clause 34A, which should be verified as an auditor, is there were two sections, 194Q and 206C1H, very important sections, and it created huge mess in the compliance industry as far as income tax is concerned, that how to go about 206C1H and 194Q. What are these two sections? 194Q talks about deduction of TDS whenever there is a purchase or payment of more than 50 lakhs, whichever is earlier, a bill or a credit, whichever is a payment or credit, whichever is earlier, more than 50 lakhs, and if in the last year turnover is more than 10 crores. And 206C1H is there, that if at all there is a person who is selling it, then the person will have to collect 0.1% as TCS. So now there is a scenario, and this was 194Q was introduced in June. So till June 206C1H was there. And there was a confusion that for a particular transaction, concerned person will deduct TDS, or should I collect TCS on the same? And because of this, there is huge mismatch on sales and purchases. Maybe those who have not got this actual scenario of 206C1H and 194Q, they might not get it. I'll give an example what is happening here. That there is a transaction of 2 crores. Your client has sold goods worth 2 crores. Now goods have been sold. You had raised the bill what you did in the bill, what is the general practice, that you had raised the bill, and in the bill itself, you had added TCS at the rate of 0.1%, 2 crores. You did it. Now, since you have done it, you will get 2 crores and 0.1% of 2 crores when you will get the payment. Now, due to confusion, the other person has deducted TDS under section 194Q on the same and has not paid you. So what has happened that now, since you have already collected TCS, so you have not got the payment, but you went and formed the TCS return, went and filed the TCS return, and you have already paid TCS on that because you are under the assumption that you have collected TCS. And the other person has deducted TDS on the same, and you will get this benefit in your form 26As. So now when I will try to match your sales with this, that okay, fine, you have sold goods worth 2 crores and you have collected TCS on the same in 206C1H, because that is reflecting in your, TCS return also. And unfortunately, because of this confusion, the other person has also deducted TDS under section 194Q, and that is also reflecting in your form 26As. So to avoid such confusion, you have to make a proper reconciliation statement in the best possible manner, if it is possible, so that you see that there is no non-compliance of 206C1H and 194Q, because you have to comment on the same. Okay. So this chapter 17B and chapter 17BB is quite important from TDS perspective. And it also talks about that what are the forms which have been filed. Generally, 3 forms are filed in most of the cases: 27EQ, 24Q, 26Q, and due date of furnishing of return. Make sure that due date is different and date of furnishing is different. Where, in many places where you do copy and paste, you tend to do this, that you copy the same in both places. Don't do that. And whatever interest is there, payment is there, please furnish all the challans. Clause 35. Clause 35 talks about the details, quantitative details in case of trading concern and manufacturing concern. You make sure that if your client is a trading concern, your relevant business head is also selected as trading. If it is manufacturing, your relevant business head is also selected as manufacturing. And there is a scenario where you do both. You select both the types of business head, trading as well as manufacturing, and you fill both the columns. And what you should do in clause 35 in opening stock, purchases, sales, closing stock, the main funda is that you try to cover the maximum item, value item. So you try to go for a ABC analysis that, there can be a scenario where opening stock, what happens generally is that whatever is there in closing stock, you put details of all the items. Don't do that. There can be a scenario that there is a sale of 100 crore and closing stock is only 50 lakhs, and whatever items you have given, that is not covering major items of sales. So you start with closing stock. For the working part, that you start with closing stock, you try to cover all the items. At the same time, go for purchase and sales also, and find out that if the major portion. Now, suppose if I take an example that you deal with 2 items, sari and iron is something which you are dealing in a very big manner. And iron you had sold worth 100 crores, and sari you have sold worth 1 crore. And in closing stock, only sari is lying with. Then obviously, if you start with closing stock, you will only end up giving the details of sari. What I'm trying to say is that if at all there is some item which is only in sales and is not a part of closing stock, and it is major part of sales, that is if 100 crores, if you have made a sale of 101 crore and major part is of iron, that is 100 crores, then you should have given that, added that line item of iron as well, where though there is no closing stock, but opening stock at all, it is there, and purchase and sales. That is for sure. Purchase and sales will be there even if there is no opening stock, because sales is there. So put the quantity of purchase and sales. Don't start with closing stock only. So you have to make sure that closing stock, maximum items are covered. And if by covering closing stock, your sales is also covered, that is a kind of icing on the cake. But if it doesn't get covered, then make sure you go through sales and find out those items which cover maximum part of sales and cover them here. Similarly, for manufacturing concern, you have to give a different, you have to work out the same thing for raw material and finished goods. For these things, obviously the inventory management system of the accounts will be there. You try to get it from that, and on your working, try to get it vetted by the client also, that this is what we have done. Please let us know if there is any misunderstanding, because this is quite innate to the business and they know it best, because there might be a scenario where you can get a different figure in a different manner as an auditor. So it is best to let them interpret, and once you interpret, you get it vetted by the client. If this is our interpretation, this is how we are going to feed it in the audit report. Clause 36A, it talks about deemed dividend, section 222E. If at all it is there, deemed dividend is there, mention it. 37 is it talks about cost audit. 38 talks about Central Excise Act. I suggest that take a management representation letter for these clauses. 37, 38, and 39 is service tax audit. Clause 40, everywhere it is filled, total turnover of the SSC. And I'm sure that in the first session or in the previous sessions, you must have covered the concept of turnover, that whatever is there in the sale, only that, those things are not covered in turnover. In fact, other than sale of goods and services, that is like, raw tip license is there, custom duty is there, whatever you are getting it back, those things are also part of turnover. So include them in turnover. Gross profit is something which has to be calculated in a particular manner, because these days, in vertical line of system, gross profit is not a part of the financial statement. So once you calculate gross profit, take a representation from the management also that this is how we are calculating the gross profit, and if there is any change, please let us know. Net profit has to be before tax. Net profit by turnover, it has to be before tax. Stock in trade by turnover, stock in trade is there. Material consumed by finished goods, this clause, serial number 5 is applicable only in case of manufacturing company. Material consumed by finished goods. Then we have clause 41. Clause 41 talks about that whatever demands or refund is there under any act other than income tax and wealth tax act, that has to be mentioned here. So you try to take a representation from the management that what are the acts which are applicable to you. Most commonly GST will be applicable. Then you find out that whether any demand or refund is there, if at all. Please furnish detailed demand raised or refund issued during the previous year under any tax law. So if there is any refund issued or demand raised under GST, because it is the most prevalent law and most widely applicable. So I'm just taking example of GST. There might be other laws also which might be applicable, like mining laws are there. Whatever industry the entity is in, so the relevant tax laws, the relevant laws will be there. So you take a list and find out. And the best is that you take a representation from them that if there is a demand raised or refund issue under that law, and try to take a copy of that demand order or refund order and fill the relevant details of the order, that on which date the order has been passed or not. Clause 42, that is a statement of financial transactions, a very important thing, that whether this is required to furnish statement in form 61, 61A or 61B. So it talks about that SFTs are filed, especially in cases for a private company, if they are issuing shares more than 10 lakhs or they're issuing dividend, declaring dividend is there, then they have to file a form in 61A by 30th of May. So if that is there, then the same has to be done here. If there is a country by country reporting under section 286, then the same has to be reported. In clause 43, whether the SSC or its parent entity or alternate reporting entity is liable to furnish the report under section 286, the same has to be reported in 43A. So country by country report is there, where I guess the limit is of more than 500 crores. That is the basic criteria, where again the OECD guidelines are there, and basis on profit sharing is there, where basically everything about that particular company, we as a MNC, whatever they are doing in other countries, we want to know in terms of from the respect of Indian government, that what they are doing and how they are planning their income and how they are flowing their revenue to other countries. That is the thing what we get in clause 43. And clause 44, last but not the least, and the most widely discussed clause as far as this session is concerned, that breakup of total expenditure of entities registered or not registered under GST. what has to be done? Look, the intent of the legislation is, and the institute ICI is also that whatever best we can do for this particular clause, we should fill this clause, and we should not keep it blank. Try to get the maximum info from your clients. How to go about it, I'll tell you. That total amount of expenditure during the year. Since it talks about total expenditure, they have not kept any reservation for capital expenditure and revenue expenditure. So that's why even the capital expenditure, wherever GST is applicable, I mean, what GST? I mean, even if unregistered entities are then also, all the expenditures, even in the nature of capital or revenue, everything has to be mentioned here. That is the first thing. So one line item. And since they have put total amount of expenditure, so there will be only one line item. It will not be vendor wise. Only one line item will be there. So total expenditure of your capital and revenue will be here. Now, once you get your total expenditure, you have to categorize that expenditure, whether it is a GST registered vendor or unregistered vendor. How are we going to do it? In nutshell, what we do is, and what is the concept? The clients maintain their accounts that for the vendors for whom we take GST input, generally they are taken as GST registered vendors, and the others for which we are not taking GST input, they are not GST registered vendors in our concept. But it might not be so, because there can be a scenario that you have bought a book and pen from a particular person, though he might be registered under GST, but since you are not claiming GST input, that's why for you, you might have categorized in your accounts as GST and registered, since you are not claiming GST input, but he is a GST registered vendor. So since, I mean, whatever stand you are taking, if you are following this concept that whatever inputs we have taken, for us, those are GST registered entities and others are GST unregistered entities, please mention it in the audit report. Sir, this is my total 100 crore ka expenditure, and out of this 100 crore ka expenditure, I have claimed input on my 80 crore ka expenditure. So that 80 crore is registered entity for me, and other 20 crore is unregistered entity for me. Now, coming to the registered entities, you have to see that have you taken any exempt goods or services from these registered entities, if at all it is there. So we will start from clause 2, that total amount of expenditure incurred during the year is 100 crores. Relating to goods exempt from GST, if at all you have received any goods or service which is exempt under GST from a GST registered vendor, then you have to mention it. So out of 80 crores, if out of 80 crores, 5 crores you have received as exempt, then you mention exempt here. Then relating to entities falling under composition scheme, I'm sure that no one is maintaining his books of accounts in a manner where they are segregating composite dealers, composite scheme entities and non-composite scheme entities. So it is not humanly possible, but if at all it is possible, you do it. Otherwise, you'd say that since the books of accounts is not maintained in a manner that which can cater to this particular requirement of the clause, where I can verify that composition scheme is done or not, then you simply don't fill it. But if at all it can be done, please fill it. And so 5 crore will come here, and relating to other registered entities, 75 will come here. So total payment to registered entities will be 80, and expenditure relating to entities not registered under GST will be 20. And you give a kind of disclaimer that the entities for which input has been taken have been considered as registered entities, and the accounting system of the concerned SSC has not been so robust or has been designed in a particular manner to cater to the requirement of this particular clause, where the composite dealers expense can be given in detail. So that's why this particular thing has not been worked out. So what I'm saying is that in whatever manner you are filling this particular, first of all, you have to make an endeavor, make an earnest attempt to fill this column. आपको ये कॉलम फिल करना पड़ेगा, पहली बात. दूसरी बात, इस माइंडसेट से मत करिए कि हम डिस्क्लेमर देकर के निकल जाएंगे. You have to try your best to fill this column. Once you fill it, then you have to start the working, and whatever way of working you are following, you mention the same. Once you mention it, as an auditor, you have discharged your responsibility and you are in a safe position. So that was it from my side for today, and we are ready to take the questions. Thanks a lot for giving me patient hearing. Thank you.
So shall we start the Q&A session?
I guess so, yes.
Okay. So the first question is from Sujata. The question is, in case of fish dealers, nature of business is fishing. The dealer have not deducted the TDS on purchase at the rate of 0.1%. Form 26A is applicable or not?
They have not deducted TDS
On
under
purchase.
section 194Q.
Yeah.
If at all a CA can verify that the same has been done, of course, yes. I guess yes. Because most of the sections are covered in Form 26A, and I'll just check whether this particular section is covered in Form 26A or not, because they have got some sections which are not covered. So if Form 26A covers this 194Q section, then I guess yes. I guess yes, 2011. Give me a sec, I'll check it right away. I have Act with me. I am just checking whether 194Q is covered in this exemption section or not.
Okay.
Moving on to, till then we can move on to the next question.
Okay. So the next question is from Sumit. Under clause 22, payment of interest to MSME, does that include loan taken from MSME? Shall I take this? May I take this?
Yeah, please take it.
Yeah. So basically, if we read section 15 along with section 23 of MSME, so it basically tells that the payment which is due with the supplier of the goods or service. So basically, this section is related with the supplier and goods and services, not with the loan part.
Okay, next.
Okay, the next question is in section 40A3, exception of payment in excess of rupees 10,000 in case of bank holiday has been removed. So for this, if we refer rule 6DD, that tells about there are some exception to the cash payment, and yeah, the bank holiday has been removed from that section, from that rule. Moving to the next question.
I guess for 194Q it is yes, 26A can be done.
Okay.
Next.
So moving to the next question. As this clause lists expenditure under section 37, however, there is no mention of CSR expenses in Form 3CD. So whether the auditor should deliberately mention the CSR expenses here or not?
No.
Okay.
No. Why it is no? Because there is a separate section for CSR and there is a separate line item in ITR in Schedule OI which talks about CSR. But there should have been a separate column in for CSR in tax audit also. But since they have not mentioned it, we should not. Because if you see the ITR, there is a separate line item for CSR in ITR. Yeah. So I guess they should have introduced it the same in tax audit, but they have not. So I don't think so.
Okay. Moving to the next question. Whether the compensatory payments, contractual breach, or liquidated damages being reported in clause 21, the section which is related with the fine and penalty. So I guess no, these are not being covered. Since in the guidance note, it's clearly is mentioned that compensatory payments, contractual breach, or liquidated damages are not in the nature of fine or penalty.
Correct.
Okay. Moving to the next question. Clause 21I talks about the interest paid for capital borrowed for the acquisition of asset. Do the interest here include service fees also?
Of course, yes. Yes. It has to be.
How to identify the principal item in stock section?
Principal items in stock section is something which the client himself will have to say, because since you are not an expert of the industry, so they have to say that which are the principal items. But one thing which can be checked prima facie is that by looking at the inventory and the consumption part, of course, you can see that if it is into construction, then of course cement and iron and stone chip is the major component. So, and that is a basic thing that as an auditor, you should have a basic understanding of the industry of your client. So if they are manufacturing something, then I guess you have to do that kind of research, and you also can take an understanding from the client. But of course, I mean, this is something which you have to mention. You cannot take a plea that I do not know. That's why I have not mentioned it.
Moving to our next question. If personal expenditure is in excess of rupees 10,000 being paid in cash and debited to profit and loss account, then will that expense be disallowed twice?
No.
Yeah.
Mention it only once.
Should we report it twice or not?
Look, ideally you should report it twice.
Yeah, exactly.
But you should report it twice, and unfortunately CPC adds it back twice.
Yeah.
So that is a problem. But ideally you'll have to report it twice. Because look, I mean, as an auditor, we are supposed to do whatever is there in the audit report. And if CPC is taking a different stand or a wrong stand, so that is a different story altogether. Then if at all they are passing a wrong order, then either you can go for rectification in section 154 or you can go for appeal.
Yeah.
But as an auditor, we will have to.
Next question is, can you please explain the difference between 40A and 40A3A again?
40A and 40A3A, this was regarding payment.
Payment of cash.
So payment in cash. Now there has been a expenditure of, suppose you did a purchase of 1 crore. Or, this is for 10,000.
10,000, yeah.
Of 1 lakh. Did a purchase of 1 lakh. Now, out of this 1 lakh, you ended up paying 50,000 in cash in this current year. And 50,000 was sundry creditors. From a single person, you bought this. Now, this 50,000, whatever is there, you paid in cash, that will be disallowed in this year because you paid to a person in a particular day, in single day. Now, this 50,000 sundry creditor, you paid in the next year in cash only. So this 50,000 in this year it will be disallowed, and 50,000 in the next year it will be disallowed in 40A3A. So 40A3 current year 50,000. Suppose I break the amount. 40,000 and 60,000. 40,000 you paid in this year. So 40,000 will be disallowed under section 40A3 in this year. Now 60,000 whatever was remained, you again ended up paying 60,000 in cash in a single day next year. So that 60,000 will be disallowed under section 40A3A.
Next question is, how to verify payment is made through account pay check or not?
Well, representation can help you, or I mean, that is the one thing where representation can help you, or you can always kind of, give that you tried your best and there is always a scope.
It is not. It is practically not possible. You can give in the observation section.
Correct.
Yeah. Moving to the next question. If I purchase fixed assets, should I capitalize initial payments regarding purchase of fixed assets like service charges, RTO, insurance, and should I charge depreciation on that?
Yes, we do that. Yes.
Yes, we do that. Next question is from Smith. Gift from friends in cash will applicable if it is received in business. Gift received from friend is personal nature. Generally, then which clause is applicable?
Gifts received from then
friend.
section 269 ST is there, na? Section 269 ST will come into play. We have a separate clause for section 269 ST. There you will have to do the reporting.
Can you explain about reporting of turnover as per GST or as per 3CD?
Reporting has to be done as per tax audit and as per profit and as per your profit and loss account, because GST turnover is always different, where you have to take into consideration the advances and all, everything is there when you talk about GST turnover. So this turnover has to be in tandem with your profit and loss account, and as per the understanding of accounting standards or Ind AS, whatever is applicable, and on the basis of accrual concept, if that can be recognized with certainty, then I guess that is your turnover.
Yeah. Can you please explain the difference? Sorry, that is an incomplete question. Harsh. I guess all the questions are covered. So
all the questions are done?
Yeah, all questions are done.
Nice. So we thank you both, sir. Good afternoon, everybody. I'm happy to share that Student Skill Enrichment Board is organizing these live webinars on every Sunday at sharp 10:30 a.m. And this is our 18th webinar, which was on the tax audit. Thanks to our Honorable Chairman, Sir C.A. Sushil Kumar Goyal ji, and our respected Vice Chairman, Sir Mupala ji, Sridhar Mupala ji. They are continuously putting all the efforts and motivating the office. We also thank our respectful keynote speaker, C.A. Durgesh Kabra ji, for sharing his vast knowledge and motivating our future generation. Today, he motivated our students a lot and thereby contributing to our society at large. Our gratitude to our eminent speaker, both C.A. Aseem Prakash ji and C.A. Ankit Bohra ji, for their contribution to make this webinar a great success. Because of you only, we are able to have this seminar, sir. I may like to express our sincere thanks to both these session speakers for giving an excellent coverage and vast insight into the topic. So you really enhance our students with enhancing their knowledge on all the questions. Also, you have given them the clarity. And the students, you can also look after the recording in the future. The same are available on the YouTube channel and on DLH platform. It is such an honor to have you both, sir. We are really thankful joining us. We are congratulating you both. Also, the seminar was a great success and lot of students were there to join. Other students, we are going to come here more topics which are going to really enhance your knowledge. Thank you, Aseem ji, and thank you, Ankit ji. Thanks a lot. Thanks to our technical support team also and Mr. Gagan ji, and to our office.
Thank you.
Thank you.
Thank you, everybody. Now we can stop the recording. Bye.